Good evening, everybody. This is Vince Turcotte. I'm with ICE Futures Singapore. And welcome to the latest installment of our ongoing series on the outlook for Bitcoin. Tonight, we're going to focus a little bit on the impact of DeFi and regulation. And we have two really good guest panelists tonight. Henrik Anderson, who's the CIO for Apollo Capital down in Australia, is going to join us for an investor's perspective. And Darren Chu, who's a regular contributor to our webinars, and who also helps us with content on our other product. Darren is with Tradable Patterns in Singapore. My role is just to get things started by giving you a brief introduction to the product in ICE Futures Singapore and a little bit of an overview of the asset class in general. So I'm going to get through this pretty quickly. I know that anybody who has seen this presentation with us before has seen a few of these slides, but we'll get through them as quickly and painlessly as we can. ICE, to begin with, has a business model where we typically look at ourselves as building new infrastructure for trading. We actually try and create global marketplaces. And the entire Bakkt story is a great example of that, where we're seeking to accommodate the crypto asset class in an entirely new environment with regulation end-to-end. So our motto or our watch phrase is we bring transparency and efficiency and market access to participants around the globe. Oh, sorry, going the wrong way here. There we go. Apologies. ICE Singapore was started by the ICE franchise in 2015. And we did this we created this ecosystem for retail and smaller investors who had balked at some of the other aspects of trading on our institutional platforms in Europe and North America. So we focused very much on making it barrier-free access with no fees for market data, cash-settled contracts that were derived from our successful ICE US and ICE Europe product offering, very low exchange fees, and the contracts are all minis as well, so that people could get going in small size with low margin and decent leverage. And yet it still has the same infrastructure in terms of the matching engines and the high integrity and security that we have on our other global exchanges. It's regulated regionally, which was another aspect that our clients had asked us to focus on. And so it's warehoused in Singapore as an approved exchange and clearinghouse by the MAS. Let's talk a little bit about Bitcoin as an asset class. And we've been using this chart for a little while now. Basically, it was spawned from an idea that we got in May from Paul Tudor Jones when he published his, I think now, famous investment letter saying that he was reallocating assets to cryptocurrencies, and in particular into Bitcoin. And he chose to illustrate that by showing what the performance of a 2% allocation out of a standard S&P 500 portfolio would do in terms of performance versus the S&P 500 just on its own. And so the dark blue line, as you can see, are annualized returns with a base of 100 at the beginning of January of 2017. Up until the present day. The chart goes right up until August 8th here. And you can see, even if we change the start point, you'd see that Bitcoin as an asset class added to a portfolio of S&P causes that portfolio to outperform. And so it is something worth looking at in terms of the diversification value of crypto assets, and in particular in terms of Bitcoin. Also wanted to highlight the portfolio implications in terms of correlation. This is something that Darren and I talk about very often. Darren likes to look at longer-term correlations, and I think he may go into that in detail when he gets to his presentation. But I think 6 trading weeks is actually a pretty long time frame for most traders. And I like to look at that because I think it's a rational way of gauging how tightly correlated the Bitcoin is to S&P 500 in particular, but we also measure it versus gold, versus the US dollar, and other assets as well. And you can see that over the same historical period, what you can see that Bitcoin has had fairly loose correlation, giving good diversification to the S&P 500 portfolio. But if you look more recently, in particular this year, you can see that as Bitcoin gains more and more credibility as an asset class, as more and more people diversify into crypto, it becomes more highly correlated. And towards the end of the graph on the right side here, you can see that it's being treated pretty much as another risk asset. So that when the markets are up and people are buying risk, they're going into stocks, they're going into commodities, and they're going into crypto and Bitcoin. So you can see here on the right-hand side that as Bitcoin gains this credibility as an asset class and more institutional investors are legitimizing Bitcoin by taking it into their portfolios, you can see its correlation is gradually tightening over longer periods of time with the stock market. I always like looking at the volatility as well, and it's ironic in this chart. We've captured some periods, in fact, fairly recently when the market was selling off this spring in stocks. You can see that the 20-day realized volatility of the S&P 500, which is the light blue line, actually exceeded that of Bitcoin. And of course, historically, Bitcoin volatility has been higher, but as it's become more and more correlated, again, with the S&P 500 as a risk asset, then it's becoming the volatility is coming more and more into line with that of the stock market. So risk on, people buy stocks and they buy Bitcoin. Risk off, they sell stocks and they sell Bitcoin. So you can see that the volatilities are becoming more correlated as well and closer, again, as the asset class gains credibility and wider usage by investors. Now, this chart is just a quick illustration of our volumes, and you can see that we've done reasonably well. I think, we look at our volumes as measured as real trades. We don't have the advantage of some of the non-regulated exchanges where they have their own market-making desks, and they generate quite a lot of that volume on their own. So in a regulated market, the trades have to be between a real buyer and a real seller. So you'll see that for us, as well as for the CME, our volumes look low compared to, for instance, the volumes that you might see on BitMEX or OKEX or some of the unregulated exchanges. But really what you're seeing here is the fact that our volumes are growing apace. And in particular, in the last 3 months, last 3 full months of this year, you can see on the lower right-hand side, July, August, and September, the average daily volume in ICE US has really accelerated. And you can see this, of course, on the graphic as well. ICE US is the light blue, and ICE Singapore is the dark blue. We have relatively tight markets and a reasonable depth of liquidity. And these two markets are, of course, very tightly correlated and highly arbitrageable 24/7. So that when there's depth of market on one exchange, that depth is available on the other exchange too, through arbitrage by our market makers. So the volumes continue to grow. Just wanted to talk a little bit in particular about the ICE Futures Singapore product and why we chose to make it a cash-settled monthly future. Now, cash-settled contracts, these are linked directly to the price of Bitcoin via the ICE Futures US deliverable contract. And what that means is the ICE Futures deliverable contract is physically deliverable with one physical Bitcoin. ICE Singapore's contract links directly to that ICE US contract, matching it in price, but there is no delivery risk. So what this enables people to do is participate in the price risk of BTC without the operational risk of delivery of physical BTC. And I think there's a growing appreciation for that, for the fact that a lot of people don't want to set up the wallets, they don't want to go through the extra hassle of custody of Bitcoin, but they do want to be able to jump in and jump out and participate in the price risk of BTC. They're traded via a normal futures account. So this gives people, again, a little bit more comfort with the regulatory structure that's around the futures industry relative to the unregulated markets in the rest of the crypto world. So the futures industry, standard futures account, you face your broker faces the exchange clearinghouse, and you don't need to set up a separate account with an unregulated exchange where you're not sure of the risk or the regulations that protect your assets. In the futures environment, you're strictly protected within that futures envelope by your futures account at your futures broker facing a regulated exchange. And again, that's emphasized in these last couple of bullets. The MAS regulatory oversight for the exchange, the clearinghouse, and the brokers that are in that chain, and with an operational and credit risk that is monitored at all times and tested aggressively by the regulator. We also believe that we have superior security and technology infrastructure to the unregulated exchange environments. We have a very large setup globally to monitor our security and our technology, and knock wood, it's performed extremely well, even under market duress. So when we've had a tremendous moves, the technology handles the moves without breakdown, and it has a very, very high wall in terms of security. We also have a 24-hour help desk that's available around the clock to make sure that your technology questions are answered and that your accounts are kept secure. Just a little bit deeper dive into that idea of being regulated and sitting in a regulated environment. Obviously, we have very strict membership criteria. One of the differentiators for us is that we do require an initial margin. We don't give extreme leverage. Our leverage is the same as it is in ICUS, and as it is roughly the same as it is in CME, which is around 33% margin requirement. We have continuous position monitoring, mark-to-market margining, and all of the same safeguards you would expect if you were trading stock index futures, commodities futures, and so on. And those three layers are very, very important. MAS oversees the ICE Clear Singapore, and the brokers are regulated under the Securities and Futures Act. And of course, client protections are offered under the Securities and Futures Act. And this is a strict differentiator with the unregulated exchange environment. Just a very quick overview of the contract specs. It's equivalent in risk to 1 Bitcoin, $2.50 per tick, and it's about a penny per contract. A penny is $2.50, and the trading hours are roughly the same. It's about 22 hours a day as our other products. And there is a 10-lot minimum block quantity. Quick side-by-side comparison of the ICE contracts with CME. Our contracts are a little smaller. CME is a 5 Bitcoin contract, so it's a larger tick, and in volatile times, it can be a much higher margin. You literally have 5 times the margin per contract. So the ticks are $25 per tick. So it's a bigger contract, but it's offering the same leverage per Bitcoin as our smaller contracts do. So there's no advantage in terms of that size. In fact, it works against smaller investors. We have roughly the same listing. CME does offer 1 or 2 longer dated contracts that are December dates. Ours are 12 consecutive months. And of course, ours settles to the price of the physically delivered Bitcoin. And this is perhaps the most important differentiator from the CME contract, which settles to an index of the prices at 5 of the unregulated exchanges. So it's interesting. I mean, you can look at the history of index settled contracts, and you wonder, what's the point of that versus a physically delivered? We wanted to make sure we did a physically delivered because we feel that that can become a new benchmark. Just as we've got the benchmark for Brent oil, we have the benchmark for the US dollar index, we have the benchmark for several other products, for cotton, for cocoa, for sugar, and so on. We are hoping that by using the physically delivered Bitcoin, that gains traction as a benchmark for the price as well. Again, if you look at the block sizes, you can see that there's 25 coins or 5 contracts for the CME and 10 contracts or 10 coins for the ICE contracts. That's really about it for me. I want to just end on this note. We want to make sure that everybody realizes that they have an opportunity to ask questions. We'd love to hear some hard questions. I have some difficult ones for our panelists after they're finished with their presentations this evening. But I want to make sure that everybody understands that this is a two-way process. We'd like to hear your thoughts on product development and your thoughts perhaps or your questions on how any of these points relate to your trading the BTC asset. With that, I'd like to turn things over to Henrik Anderson. Henrik is the Chief Investment Officer for Apollo Capital in Sydney, and we always like to have the perspective of a real user. And Henrik is going to be that guy for us tonight and talk to us a little bit about his views on the markets, on DeFi, and on regulation. Henrik, over to you.
Thank you so much to you, Vince, and to ICE for having me today. So I'll first talk a little bit about the outlook for Bitcoin and crypto in general. From our perspective, the backdrop for institutional adoption of Bitcoin is perhaps the strongest it's ever been. After COVID, we have seen unprecedented levels of government monetary stimulus, and Bitcoin is increasingly being viewed as a digital gold and a store of value. And that, I think, narrative has been growing stronger. I think, getting back to some of the points you made as well, Vince, we're seeing lower volatility in Bitcoin, which I think boosts confidence among institutional investors. I think many investors also see inflation picking up long term, and I think that will strengthen the case for assets such as Bitcoin and gold that are scarce. In general, we have very low yields in the world, and we have other asset classes trading at fairly high valuations, such as stocks, which are globally close to all-time high levels, as well as the bond market. And then you can look at Bitcoin, which is 50% off its peak, where it was 3 years ago. So we've seen some macro hedge funds starting to view Bitcoin as an alternative to gold and made some investments. I think, Vince, you mentioned Paul Tudor Jones as one example, who published his investment thesis around 6 months ago, and it has to do with his view on inflation going forward. I'm also going to talk a little bit today about two interesting trends we see in the Bitcoin market at the moment. One is that Bitcoin is increasingly being used in decentralized finance, or DeFi. And another one is that is a little bit interesting, I think, is that some companies are starting to adopt Bitcoin as a treasury reserve asset. Also here, I want to mention how Bitcoin and crypto can fit into a portfolio. So you mentioned that as well, Vince. When it comes to correlations, we have...
Hi, folks. We're having just a little bit of technical difficulty with Henrik's internet connection. So I'm going to move along quickly to Darren Chu from Tradable Patterns, and Henrik will come back to finish his presentation when he gets reconnected. Darren has been working with us at the ICE for, gosh, Darren, I guess it's about, I don't know, 6 months, 7 months now. And he's provided a lot of our commentary, and then I'll let Darren introduce the rest of himself and his services. But he's been working with ICE on several different presentations. So without any further ado, I'm going to flip down to Darren's presentation, and then Henrik can come back in and finish his when he's back on. Darren, can you take it from here?
Thanks, Vince. Sure, let me just navigate over to my set of slides. Okay, let me just, we got you here. I think I need to scroll. Okay, here we are. Hi, everyone. My name is Darren Chu, and I'm the founder of Tradable Patterns, a company which I started soon after leaving the exchange world, actually. So I created this company to provide analysis for all the hedge funds and prop traders and all the service providers out there interested in pattern recognition. So there's a lot of informational value that comes from just looking at chart patterns, a lot of trading psychology that can be deciphered from just looking at price movement, volumes, and derivatives of that. So that well, that eventually, I guess, expanded to cover more than just the traditional asset classes. Now, I come from, I guess, the traditional futures and options FX space, and about 2.5 years back, I launched a crypto newsletter, and as Vince was just alluding to, we've been, between ICE and I, we've been collaborating on some content on a bi-weekly basis. So, make sure you guys all look out for, an upcoming alert to our next bi-weekly piece. It generally comes out on the Tuesday or the Wednesday, so our next piece should come out next Tuesday. So just to, I guess, talk a little bit about I guess, the buzzword that we've all been tuning in today for. Really, DeFi is really driving a lot of fresh interest, I think, and also, building on what Ethereum and, some of these other, call them foundational blockchains, has been driving over the last little while. So DeFi really has been, it's been around for well over a year, but it really has been in the last probably 4 or 5 months that it's really exploded onto, I guess, much of the mainstream media coverage of all things crypto. And so I'll talk about what that relationship between DeFi and Ethereum is, why we should talk about Ethereum or pay attention to what's happening with Ethereum. And I'll obviously tie this discussion in with, how it relates to Bitcoin, why it's driving adoption of Bitcoin and vice versa. There's a two-way relationship that I'll explain in a little more detail in the next few slides. So just going back to Ethereum, as most of you know, and just to bring everybody up to speed, since we probably have a few people in the audience who may not necessarily be trading Ethereum or holding it or even following it, it really is the second highest market cap crypto token. On the terminology, let me just be very clear. Quite oftentimes, people refer to Ethereum specifically as the blockchain that underlies the token known as Ether, okay? But quite oftentimes as well, depending on the financial media that you're actually getting your information from, Ethereum and Ether may be used interchangeably for instance, on price charts. But just to be very clear, Ether should refer just to the crypto token itself. So when you're looking at the quote on this particular market, what's tradable would be the Ether. And also, just to be clear, the Ether also refers to the actual transaction fee, which various processes that take place within the blockchain of Ethereum incur. So when you send an Ether token, to somebody else, or when you have a smart contract executing, there are fees involved, and these fees just vary depending on the actual transaction happening. Okay, so as with Bitcoin having smaller, you can call them subunits, there's something known as a Satoshi, which would just be 1/100th million of Bitcoin, of one Bitcoin. In the same sense, Ether also has a smaller unit, and you'll see this so-called gas fee quite oftentimes quoted in that particular term, and that's just spelled G-W-E-I, Gwei, I think it's pronounced. But anyways, I just wanted to sort of focus on why we should pay attention to what's happening within the Ethereum ecosystem when discussing DeFi. Quite oftentimes, you hear how Ethereum facilitates what's known as smart contract functionality. And it's that kind of functionality which can be programmed off the Ethereum blockchain, which lends itself to being a platform ideal for launching DeFi apps or dApps, decentralized apps. And what we've also seen spun off or launched from the Ethereum blockchain beginning around 2017, or perhaps reaching a peak in 2017 towards the end of that year, were the altcoins. A lot of these so-called ERC20 tokens were spawned off that blockchain, and we had perhaps about a year later a proliferation of additional stable coins, and quite a few of these are linked to the US dollar, and we also have exchange coins which serve a different purpose. But if you just think about how when transacting on certain crypto exchanges, there are fee breaks, discounts when making payment using the exchange coin, the coin launched by the exchange itself. Okay, so just to put things in perspective on how the growth of a lot of these stablecoin or exchange coin volumes and also DeFi application volumes have driven the use of the Ethereum blockchain. You can see in this graphic here, let me just try to get the highlighter here so that I can sort of illustrate what I'm talking about here. I understand this graphic might be a little small, but basically what you're seeing here is that the actual token, the ETH, as ETH is referred to as, it is generally, you can see here that, over time, more and more of the actual transacting in that token has been accounted for by the transferring of stablecoins and exchange coins, as well as in making payment for these DeFi applications. Okay, so as opposed to just sending the Ether coin, if you will, to somebody else, from one wallet to another. Okay, so that's what that chart illustrates. Okay, so on this next slide, I guess the emphasis here, without going into too much detail, is that a lot of the participants in this ecosystem, they understand that the existing Ethereum network is getting rather congested. So a lot of the various transactions that have been taking place or trying to take place over the last, particularly in the last 6 months, as the DeFi adoption has really accelerated, we've seen a surge in these transaction fees, and also a slowing down in the network, an increase in confirmation times. And all of this was quite anticipated quite some time back by the creators of Ethereum, or whoever helps maintain that blockchain or helps innovate on these next level iterations. And so Ethereum 2.0 is being slated basically in different phases. So we have phase 0, which hasn't actually kicked in yet, but it initially was hoped for on the integration, on the adoption, sometime around September. That hasn't quite happened yet. It's October now, but we're still looking at the first stage of this Ethereum 2.0 kicking in late this year. Okay, but essentially what's going to happen is that we're going to move from what's called proof of work to proof of stake on the algorithm of validating the transactions. So that's going to allow more people, more participants to take part in what's called validating through staking on the Ethereum blockchain of transactions. So rather than mining, and this is going to leave a lot of the existing crypto miners who are active in mining Ether, it's going to leave them with a decision where they're going to have to decide once this transition happens to proof of stake, whether or not they just sell all their mining equipment and exit that business altogether, or continue mining with other coins, right, using existing equipment. Or of course they can I guess always purchase new equipment for coins that are not mineable using their existing server technology. Okay, so one of the real highlights that everyone's looking forward to is sharding. Okay, so that's pretty much expected for 2021, but that's going to allow for far greater scaling of the transactions that take place on Ethereum. And right now, there already are these so-called level 2 solutions where there are these options which are mentioned here, OMG, for instance, where transactions can be bundled up and they could be kind of processed off-chain somewhere else, and at a certain point in time, sent back onto Ethereum for the transaction record keeping. Okay, so that's already available. Now, when we look at this graphic, what we're seeing is just a timeline, and this is really mostly already completed, right? So we're really just looking at these remaining 3 phases. Some people might just call it 3 phases as opposed to 4, but those 3 phases are what has been largely driving the anticipation that Ethereum will become scalable and will allow for the actual promises that a lot of people who are participating in DeFi are expecting down the road. Because what's really bottlenecking a lot of the DeFi activity has been just high transaction costs and the time it takes to confirm transactions. Okay, so what we're looking at here, just to contrast what we see between Ethereum and Bitcoin on the network transaction fees, is in this graphic we have a red line, which would be your Bitcoin fees, and you have, okay, so down here, and then up here you have the Ethereum ones. So we've actually seen, and I'm not quite sure if you guys from this graphic whether you can make out the x-axis, but basically over the last several months you can see that the fees of Ethereum overall have exceeded that of, okay, these are total fees in USD, okay? So the total fees on Ethereum has actually exceeded, for most of this period, these recent couple months, of Bitcoin. Okay, so that's quite notable. I mean, the miners for Ethereum, on the Ethereum blockchain, who receive Ether as a prize, they've actually been earning more in terms of US dollar revenue from the mining of Ether. Okay, so over here, what we're looking at is how since, I guess, mid-April, and I realize we're in October already, but you can see here from where I've circled that the total value transferred on Ethereum, on the blockchain of Ethereum, reached parity with Bitcoin back around mid-April. And unfortunately, I don't have a more recent slide, but that just gives you an idea of how things stack up between the 2 blockchains. And over here, what we're looking at is on the top graphic, we see the active, first of all, the white line up here refers to the percentage growth in Ether wallet count. Okay, so unfortunately, the y-axis might not be clear from your guys' view. Apologize, the graphic's kind of small, but I guess what I'm just trying to illustrate is the percentage growth has exceeded on the Ethereum active wallet growth versus that of Bitcoin. And on the lower graphic, what we're looking at is that the total number of active wallet addresses in the case of Bitcoin being the one in blue, and the one in red would be the Ethereum. Okay, so this is total active wallet count. Okay, so just to be clear, there is a difference between total wallets and total active wallets. Okay, so you can always go to these websites here just to get a little more insight on how they define those stats. Okay, so in terms of actual developers that are committed to both blockchains, as of July 24th, and sorry, this is almost 3 months ago, but again, just to give you a rough idea, Ethereum, in terms of actual transactions per second, it was sitting at roughly 13 versus Bitcoin's 4. And in terms of developers involved, as of March 7th, early March, we had just under 100 developers committed to Ethereum, and that's roughly 2 times many as we had for Bitcoin. And so that just gives you an idea of how robust the commitment is from the developer community. And looking at these graphs here, with the one on the top, this chart here is basically of the Bitcoin hash rate. So, many of you who either are involved with miners or just watch this particular statistic would have noticed that we've reached an all-time high. So we had an initial dip after the third halving, and Ice and I, we had another webinar shortly after that third halving in May. And so at the time, we were at about here, and we dipped a little bit, and then we rebounded in time since. So there were little dips in between, nothing moves up in a straight line, but I guess the overall trend has been up, which suggests that the Bitcoin miners are still very much of the belief that what they produce will be worth their commitment in terms of server technology and electrical bills and so forth. Okay, so in the chart down below, what we're looking at is the Ethereum hash rate. Now this chart, I took a screenshot of just over the weekend, but what another provider of the hash rate for Ethereum has actually revealed is that we are actually at an all-time high. Okay, so that is not apparent from this particular provider's chart, but we basically have seen a surge in the last few months due to the rapid accelerated adoption of DeFi, okay, which we'll now talk a little more about. So DeFi, and apologies if Henrik was about to explain this on the slides, but I'll just try to get through this quickly. DeFi just stands for Decentralized Finance, and I guess the reason why it ties into Ethereum is one of several blockchains, but perhaps the one that's got the most developer commitment, the most actual decentralized apps actively being built on it, that fulfill a lot of the initial promises or hopes that many in the crypto community had for DeFi. I mean, as a concept, DeFi, as I mentioned before, was something that actually people had already been planning for or outlining several years back, but a lot of the initial projects suffered from scaling issues and perhaps regulatory issues, which we can discuss a little more if we have time. But I think I'm already a little over on time, so I'll just quickly go through this on the use cases. DeFi really has been most popular for earning interest, and this ties to my key point, which I've been making since a few slides ago, in that there is an ability right now for those who already hold, for instance, Bitcoin, to earn interest on that Bitcoin by having products like WBTC, which can be thought of as a wrapper or an ETF-like structure, something that allows somebody who actually holds Bitcoin to basically transfer that to some custodian who then creates a WBTC sitting on the Ethereum blockchain, which then can be transferred over to some DeFi app where interest can be earned. I mean, that's basically the relationship between all these different products. And DeFi can be thought of as building blocks or Lego blocks that, like with any open source software, is very much modular in how it's designed. A lot of these projects are being rapidly deployed through that open source idea of sharing code and building on existing projects. Okay, so other projects that we've seen really take off have been derivatives of different kinds that we see in the traditional financial world, basically being replicated through various iterations that have no utilization for a central party. Okay, so in terms of the growth of DeFi, we can see from the slide here that the chart basically has been almost a straight line. We've had a little dip here back in September, early September for, this is the total value locked in DeFi. So what this really means is when you pledge, when you collateralize for instance, your Bitcoin or your Ether to some DeFi service where you are benefiting through perhaps interest that you collect, you're adding to this total value locked chart. Okay, so that's what that illustrates. So that is not the same as market cap. Okay, so it's not to be confused with market cap of different tokens. But just to put things in perspective, we have seen records being made pretty much every month. Now we've had, within DeFi in the last couple months, right? But what we've seen in September and since early September has been the deflating of what many are calling a bubble. Okay, so this has been fairly cautionary. It's a market or an ecosystem which has been quite. As you can see here, the drops have been rather pronounced, and really like a key driver of this growth, I would have to say, would be just a lot of the flocking over to marketplaces where early access to tokens that represent this kind of growth of DeFi can be traded ahead of them being listed on centralized exchanges. Okay, so this chart here just makes the point that the DeFi growth, as expressed through decentralized exchange volumes, is actually grown as of August all the way up to about 5% of total centralized exchange volumes for crypto. Okay, so I spoke briefly about WBTC. I really would be happy to answer more questions perhaps towards the end around the WBTC for those interested, but in the interest of time and just to ensure I allow Henrik enough time to finish off here, just want to say, while we have seen incredible growth in the DeFi space over the last 6 months in particular, we have also seen a lot of projects that perhaps have been poorly coded, a lot of cloning going on, because of the fact that we have open source projects having code ripped off from existing code bases. Oftentimes projects aren't properly audited, and etc. But Henrik could probably speak more to that on his slides. Very quickly, since tradable patterns is all about pattern recognition, I thought I'd just give a few comments around where we are technical analysis wise on Ether versus US dollar, okay, versus Bitcoin versus US dollar. We see a correlation on this particular chart, which is a 5-year weekly chart, of near 1. Okay, so these two markets are very closely correlating, and once again, this is the weekly chart. Looking here on the monthly chart, this is a 5-year monthly, we see that we have been making a series of triangles, basically consolidating. Okay, we've been making an effort, particularly in the last week or so, to continue pushing higher. And with the chart on the following screen, we can see that the momentum indicators, at least the RSI and stochastics on this time frame, appear bottomish, as does the MACD. Okay, it looks like it's trying to make a positive cross here. This is just a daily chart, and just really quickly, I just want to say, for those who do want to keep up with what's happening on a weekly basis, my website, tradablepatterns.com, it has my crypto content on Ethereum, Bitcoin, and Ripple, or XRP, published every Sunday. And every second week, you can see the content that I collaborate with ICE produced, again, made available on the Tuesdays generally. Okay, so this coming Tuesday will be our next edition. Okay, I think that's really it, guys. I just wanted to, pass the baton back over to Henrik and Vince, and these are my contact details for anybody who wants to get a hold of me. Thank you, guys.
Thanks very much, Darren. I appreciate the background on Ethereum in particular, and on DeFi. If we could please regress the slide back up to Henrik's presentation.
Yeah.
And here we are. I got it.
Okay. Go for it.
So, okay, Henrik, I think that you were on.
Yeah, I think I opened my first slide. So
there we are. Back to Henrik Anderson from Apollo Capital.
All right. So I still see slide 55 here on my side. I was talking about how Bitcoin and crypto have a very favorable outlook, especially for institutional investors. I was talking about the correlation of crypto assets to more traditional assets. I just want to wrap up this slide by us mentioning the Bitcoin performance year to date, which is 60% or close to 60% year to date. Some other major asset classes, gold is up 27% and S&P 500 is up some 9% year to date. So you have to put that in perspective. And let's move through my slides very quickly here since we don't have that much time left. But when it comes to the regulatory picture, and this is very kind of high level, 3 years ago, we had a very active ICO market. So ICOs are initial coin offerings that has now more or less been regulated. Those deals are now struck through something called SAFT agreements, which are securities and regulated as such. We're also seeing great regulation when it comes to exchanges, especially fiat exchanges that deals with traditional currencies. So the on and off ramps are being regulated around the world. We also have, as we know, Bitcoin futures trading on regulated exchanges such as ICE-backed and CME, and they have been doing that for close to 3 years now. Another very big kind of improvement when it comes to the infrastructure is the custody solutions that are available to institutional investors. We have qualified custodians in the US and elsewhere. Many of them offer insurance on the crypto holdings. And then I think it's worth mentioning as well that we had a clarification from OCC just a few months ago where they say that the US national banks have the authority to provide cryptocurrency custody services for customers. So that whole custody piece has really improved in the last 2-3 years, I would say. And I think the last point here is that there is increased pressure on unregulated exchanges. We've seen the US authorities taking measures against BitMEX recently, and I think we might see other exchanges where, especially that serve US customers, could perhaps face similar action in the future. I think where the battlefield will be the next coming years when it comes to regulatory issues will be around piracy coins and around withdrawing crypto assets from regulated exchanges if you have to do that through whitelisted wallets. I think Darren was touching on this as well, but one of the explosions we have seen recently when it comes to DeFi is Bitcoin being moved from the Bitcoin blockchain to the Ethereum blockchain. And this has really blown up this year. We now have $1.5 billion locked up in DeFi in terms of Bitcoin. 75% of that is wrapped Bitcoin, WBTC. As Darren's mentioned, 25% of that is REN BTC. That's the chart to the right here in this slide. And what this means is that this is becoming perhaps a new collateral for decentralized finance. And it's also a way for people who hold Bitcoin to earn a yield on those Bitcoin by transferring them to the Ethereum blockchain and using them in DeFi. So right now there are over 131,000 bitcoins that are being used in this way in DeFi. So this has the chance to increase the demand for Bitcoin, or is at least a new demand source for Bitcoin. Another very recent trend that I think is interesting and worth mentioning is the number of Bitcoin held by public companies on corporate balance sheets. The most talked about is MicroStrategy, which put $425 million of the treasury funds into Bitcoin just the last few months. We just earlier this month had Square that put $50 million into Bitcoin. I think with rates at 0 and target inflation of over 2%, I think there are some treasuries that are looking for alternative assets. Worth mentioning as well is that Square is offered a guide to how to go about it to other companies. Like you mentioned as well, Vince, the traditional portfolio can benefit from having a small part of crypto in it for the risk-return profile. When we look at Bitcoin futures and options as well, I think the point I want to make here is that we have futures trading on regulated exchanges like ICE and BACT now. We've had that for a few years now, and we have seen record volume this year on these regulated exchanges. And when we see traditional managers like Paul Tudor Jones and other micro type of hedge funds entering the market, they mostly do that through the futures market on regulated exchanges. If you look at the chart down to the left, we saw over $5 billion in aggregated open interest earlier this year. And the same story is true when it comes to options. So when we're looking at Bitcoin options, open interest is at record high levels as well, around $1.5 to $2 billion. And that's up 4 times in 12 months. I just wanted to mention decentralized finance as well. And I believe actually this is my last slide. So I'll just finish up with a note on DeFi. This is, I think, the top right chart here is the same as Darren had when we look at total value locked, which is a measurement of the value in DeFi. It's gone from under $1 billion at the beginning of this year to over $10 billion at the moment. And for us at Apollo, this has really been the low-hanging fruit for smart contracts for quite some time. And for us, the way we look at it is the first time in human history that we have permissionless innovation in finance on a global scale. And we've seen new DeFi primitives being crystallized in this market. We're talking about lending, borrowing, synthetic assets is perhaps the biggest vertical within DeFi, derivatives, decentralized exchanges, and decentralized asset management. And when it comes to decentralized exchanges, that volume has really picked up recently, and we have seen new record high volume for DEXs the last few months. And some of these DEXs are now at higher volume than some more traditional centralized exchanges in the crypto space. So this is really a tremendous growth right now in DeFi, in the crypto space, and that's where we are focusing a lot of our efforts at the moment. So that was my last slide. Thank you so much, and hopefully there is some time for questions as well.
That's great. And thank you, Henrik. And thank you, Darren, as well. I think overall it's been a pretty educational evening. And I guess I've seen a couple of questions, and one of the ones that I think, naturally occurs to me as well is, the risk of the asset itself. Now, when we were talking a little bit about Defi and the way it's sort of pulled some Bitcoin out of the system, out of the Bitcoin blockchain and into the Ethereum blockchain, and sort of impacted the supply. How much of the supply has been impacted by this? How much supply have we lost in percentage terms from the BTC blockchain into the wrapped products and other aspects of the decentralized finance? Either one of you can jump in and answer that.
Yeah, when it comes to new supply coming to the market and the growth in DeFi, we see actually a very large percentage. If you look at the percentage of the new supply coming to the market in Bitcoin is 6.25 Bitcoins every 10 minutes that comes to the market. And if you compare that with the 131,000 Bitcoins that are now locked in DeFi, that's a very high percentage. But if you look at the total amount of Bitcoins, the whole stock out there, you're talking about perhaps at tops a few percent.
Okay, so if it's a few percent of the total supply of Bitcoin, do we expect it to be a real impact on the asset itself, on the price of Bitcoin?
I think there is a chance that we will see a real kind of demand coming from DeFi if this trend continues, right? And that's the big question mark. We're seeing, as Darren mentioned as well, a lot of congestion on the Ethereum blockchain. And there will be some time before that is solved through layer 2 solutions and further down the line in terms of Ethereum 2.0. But for now, we see the growth in DeFi continuing, and I think it will be increasingly important.
Okay, I think here's a question that I can't answer. I'm not allowed to because of my position. The gun to head, what's the next move for Bitcoin futures and for the asset itself? Higher or lower? I mean, I noticed the price action's been pretty reasonable lately.
Yeah, I'll take a stab at that. So it does look like to me, and please, everyone, do your own due diligence. This is not advice. I do think that the consolidation that we've seen in recent weeks is coming to a close. So we've actually seen pretty good strength, particularly in the last couple of days. Suddenly we're at about 11,500 on Bitcoin, and we see ETH at about 380. It looks like it's getting ready to challenge 400, and even Ripple XRP is coming into the 26, 27 cent region, and that can really move, right? Like percentage-wise, as we've seen in the past. So yeah, I do think that there's obviously a high correlation between Bitcoin and the S&P 500, but we've also seen the S&P 500 rebound quite strongly in the last week in particular, the anticipation for the next stimulus package, right? Which hasn't been finalized yet, but there's a lot of expectation that will go through before the election, U.S. election. And we'll see what happens early November, right? That's going to be another particularly highly anticipated date on, on what that means towards Bitcoin as digital gold, and all the ramifications that may come from a contested election. So that's typically, I think, the date that most people are going to be tuned into in the next month.
Okay, well, I think we have another question that came in that's actually pretty relevant, and this is one I can take. It's how far are we away from a backed Ethereum future? So an ETH future on being listed on Bakkt. And I can tell you that it's been looked at. The project is in hand. We have a product development cycle at the ICE, which right now has 2 or 3 different items on the agenda. For ICE Singapore, we're first looking at diversifying the currencies that we trade against BTC. And the BTC contract we will likely launch versus yen versus JPY coming up in the next several months. We've also discussed the idea of a mini future, in other words, cutting down the size of the contract in order to allow for a little bit more participation. And to answer the question of what we would do in terms of deliverable in terms of ETH, that I believe remains undecided. But that product is being looked at by ICE US. And again, it's part of the product roadmap, but I cannot tell you how far along they are on it, just that it's in the queue. So who are the normal participants in the futures contracts? It's interesting that question would be asked. We see a lot of different types of traders. We see some, I think as was pointed out by Henrik, we see some real money accounts that are using the futures to diversify holdings. And they've elected to use the futures because their investment mandates won't allow them to trade on unregulated exchanges. So we are seeing legitimate players, and of course, not only in our futures contracts, but in the CME as well. People who have to steer clear of the delivery risk or the risk of an unregulated exchange. So we are seeing the early conversations in terms of adoption by mainstream investors. I cannot say whether or not banks are in that group. I think that more likely not currently. Particularly, it depends on the regulatory jurisdiction that the banks are in. I know that many banks have prepared themselves to be able to take exposure in their portfolios, but in most regulatory jurisdictions, they have not. The settlement price at the backed warehouse, including transactions costs. Now, that's something that we can take offline, but I will tell you that the advantage to using the futures contracts and the backed warehouse are that we use a fixed amount for settlement. We don't charge a tremendous amount relative to other exchanges, and we don't charge a highly variable amount in settlement price. So there's a ticket charge, and it's not free, but it is lower in general than most of the exchanges that we compete with in the unregulated space. I guess the other feature to be aware of here is that because they are regulated as standard futures accounts, it means that your money moves just as it would for any other futures contract. You call your broker, T+1, he can release the funds, any or all of it. And that is, again, a feature of using the futures contracts as opposed to trading in the unregulated environments, where we understand there are very often delays and limits on the amount that you can withdraw from your holdings. Are there any other questions or comments? Well, once again, then I'd like to thank Henrik Anderson of Apollo Capital and Darren Chu of Tradable Patterns for joining us this evening. My name is Vince Turcott, and with the ICE Singapore. If you have any questions or comments, please feel free to come back to us using the links that were supplied with your invitations. And this webinar will be available in recorded format to all of the participants and registrants. So once again, thank you for joining us this evening. Have a good Tuesday night, and we'll talk to you soon. Take care.